Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Last time I wrote the following, and I quote, "The market has formed a falling wedge pattern." Now, falling wedge patterns are not the best of patterns to show direction. The data suggests that just under 70% of the time they have a bullish breakout, however their tendency to have false breaks is quite high. Additionally, I cannot give a measure for a target X until the breakout occurs, which hasn't happened as yet. So we're all still a little in the dark there. End of quote. That was just prior to the Easter break, and this past Monday the market made a confirmed break higher over the optimized upper downtrend, currently at 597. Prices halted for a few days at the then declining short moving average, currently 619, before pushing through yesterday and halting at the next series of resistances, the medium moving average, currently 631, and the recent 50% Fibonacci line at 629. However, today prices have pushed up past these and have seemingly started to slow down at the combination of the short medium moving average, currently at 642, the lesser 38.2% Fibonacci line at 644, and the overhead congestion from the double top formed between December 2020 to March 2021, starting from 640 and stretching up to the 50% Fibonacci line of the big 2012-2015 move at 670. I'll speak more of this double top formation shortly, but first, targets for the falling wedge pattern. Well, target X2, the initial target, has already been reached today. Further target X3 in the 685 area is still there topside, but is quite a large ask really at the moment, in the midst of the big congestion from 2013 and 2014, from 675 all the way up to the 720 area. Now this area has put paid to two earlier attempts higher, as you can see. Now, as to the double top formed earlier, this still has, a provisional target X in the 580 area, with a fuller target X1 in the 567 area. Now I warned last time about a false break below, but I do not think that move down from the middle of March was a false break. Rather, it was halted by a stronger force, or as I put it last time, and I quote, "The next real test will be the slowly rising long moving average below, currently 594. End of quote. Prices reached that long moving average 2 Wednesdays ago and immediately recalled with what turned out to be a counter to the counter, key reversal up and possible bullish double. As you can see from the labeling, the market has already experienced indecision on an intraday basis rather than intraday basis. It would take, yes, six countering moves to finally dissuade the market from trying lower and instead have a crack at the falling wedge targets. Yet even now, with target X2 achieved, I am loath to remove the targets below. Why, you may ask? Well, it's because it is still only the 1 day over target X2. I am naturally cautious and conservative. Let's see if the market is serious about reaching target X3 first. Chicago corn. The peak of the market 4 weeks ago was also its watershed moment at the time, as prices made a weekly key reversal down that very same week. This after rallying since last summer. I suppose in a sense the weekly key reversal down did have an effect. It stopped the market rallying further. Since then we have started going sideways within the range of that week, which is 523 to 572. But most recently we had started to head lower, which is easily seen by the short moving average, currently 540, acting as a proxy for an intimate downtrend until last week. Now 2 weeks ago I wrote, and I quote, "To be honest, the action since February does look like a topping action a bit. Even the mid-February to date action looks a bit like a descending triangle, but nothing will be sure until prices break down through the May 2014 high. That's at 523. I added 2 weeks ago this significant piece, and I quote, "I still think that is true, but I would like to expand upon it a little. Looking at the action for 2021 so far, I suspect we may have a larger pattern in operation. A possible roof pattern, sometimes known as a half diamond pattern. Now, roof patterns are rare, but I saw one work in LME copper recently as a bullish continuation. Now, these can be both bullish and bearish, though the likelihood is about 60% bearish. I cannot give a possible target on the upsides as it would require a confirmed break of the February to date downtrend. However, it is possible to give a potential target X for the downside due to the flat base. It would be in the 492 even area." End of quote. Well, as I alluded to earlier, last week was important. The market tried lower, failed, and then tried higher, confirming the break over the downtrend that made up both the descending triangle and the roof pattern earlier this week. That caused me to relocate the earlier target X from the 492 area to the 558 area. That is a target for both the descending triangle and the roof pattern. Yesterday that target was achieved. The question now is whether the market will try higher to the previous high at 572 and exceed it, or stall at it. Above that high we have the gap left over from June 2013 between 586 to 590 should we try higher. But right now it's looking a little bit like shooting star pattern, type 1 bearish, but it will depend very much on where the close is. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.